At one point in time, Silicon Valley Bank was trading at over $700 a share, had a market capitalization of almost $40 billion, had $200 billion in total deposits, and was the 16th largest bank in the United States. The bank appeared to be firing on all cylinders. So how could this behemoth of a bank experience a run and fail in the span of some 48 hours? Like most things, there isn't one cause for such a massive failure. Perhaps the management team could have done a better job. Perhaps the regulators could have exercised better oversight. Or perhaps it was the customers, i.e. the venture capitalists, who eventually buried the company. Or most likely it was a combination of all of these three factors. In my view, the primary cause was the failure of the bank's management team. But more on that just a little bit later. In this video, I'll cover off on all of these factors and perhaps what's coming next, particularly with respect to the impact to the regional banks. Before we talk about the causes of the failure for Silicon Valley Bank, let's discuss the bank itself. The story of Silicon Valley Bank is really a story of greed and excess. While the bank was founded in the early 1980s, it really grew substantially as the excesses of the tech sector grew after the global financial crisis. The period after the global financial crisis was characterized as a period of easy money, low interest rates, and rampant speculation. It was a period where terms such as meme stocks, cryptocurrencies, SPACs, hodlers, and diamond hands, to name just a few, became household names and terms. All sectors, but particularly the tech sector and the finance industry, venture capital, and private equity did extremely well. Even Silicon Valley Bank, this website, isn't quite like that of any other bank. Central features of the bank's website focus on private equity and venture capital banking funding, which is very, very different from the bank sites of, say, JP Morgan or Bank of America. It's essentially a bank that capitalized on this period of excess. With so much money floating around, bank deposits rose exponentially from $60 billion to $200 billion between 2020 and 2021. It was a cool bank for the right time, with a catchy name, and was placed perfectly in the Silicon Valley, and was built to essentially capture the excess of a high-flying tech environment. Bruh. Every measure of the bank, whether it's the growth in stock price, revenue, EBITDA, net income, or growth in assets, all captures this period of excess. But like all high flyers, things eventually must come crashing down. So what caused the crash of Silicon Valley Bank? Well, to understand this, it's important to understand how commercial banks make their money. In simplest terms, banks take customer deposits and either loan them out or invest the money. The goal for the bank is to generate a higher rate of return, either through loans or investments relative to what they pay the consumer as interest. Banks need to maintain a certain amount of money on hand to address day-to-day customer withdrawals. Similarly, when it comes to investments, it needs to be done in a manner that those investments mature at a regular cadence, such that there are always available funds to meet the needs of customers and consumers and clients. This is all fundamental banking 101 stuff. There are fancier terms that can be used to explain this, such as asset liability management or ALM, also called as managing cash flows. But the principles are all essentially the same. Now, obviously, when it comes to investments, banks, similar to everyone else, want to maximize returns. Therefore, they want investments with the highest rate of return, but also are relatively safe. The trick, though, is to have a view on where interest rates are and where they're headed, such that all the bank's money isn't tied up in investments for a long period of time, which would, of course, take away from the opportunity cost or flexibility on changing their investments. If the funds are tied up for too long, then other more compelling investment opportunities may emerge, which the bank may not be able to take advantage of. Managing interest rate risk, i.e. the fluctuations in interest rates, is a core principle of banking and is also banking 101. Now, there's a little bit more complexity associated with terms such as held-to-maturity securities, available-for-sale securities, mark-to-market accounting, and other terms. But to understand the nuances that contributed to the failure of Silicon Valley Bank, the basic understanding is more than sufficient. The failure of Silicon Valley Bank can quite frankly be linked to a lack of understanding of these basic banking 101 principles, and also shows the ineptitude of the bank's leadership team, risk management team, and of course the board of directors. The bank amassed a large amount of customer deposits as venture capitalists and their portfolio companies maintained significant deposits at the bank. The bank took most of these funds and invested a significant chunk of it in long-term treasuries and mortgage-backed and government-backed securities. These relatively safe investments are commonplace amongst banks, who ensure they don't lose their customers' clients' money. However, it's also typical to invest in assets with different maturities. Having investments for the short term, medium term, or long term allows greater flexibility in not only meeting the needs of customers, but also for allowing banks to maximize the returns of these safe investments. But of course, not Silicon Valley Bank, as clearly the rules do not apply to them. As I mentioned earlier, the bank invested in long-term securities with the intent of holding them to maturity. Thus, when the interest rates started rising furiously over the last year, thanks to the Fed of course, the investments made by Silicon Valley Bank deteriorated rapidly. And we aren't just talking about a few $1 billion here and there. The bank's securities portfolio increased from $27 billion in the first quarter of 2020 to $128 billion by the end of 2021. Think about that for a second. If you have access to an investment that gives you a 1% rate of return and a different investment with the same or similar amount of risk that gives you a 4% rate of return, you would obviously choose the investment with the 4% rate of return. Since no one wants the investment with the 1% rate of return in this scenario, it will drop in value, and that was essentially what was happening with Silicon Valley Bank's portfolio. Silicon Valley Bank's unrealized losses on its securities portfolio at the end of 2022 was in excess of $17 billion. While the investment portfolio was going to heck in a handbasket, there was also another mounting issue. Customer deposits balances started declining. Yes, those same customer deposits that were rising when money was easy started declining. This was due to customers burning through cash to keep the lights on since they weren't able to obtain new money through fundraising and public offerings. As we all know, the public offering or the IPO market is completely come to a halt. See, investors were becoming increasingly more careful in what they were investing in. Money was expensive due to rising interest rates, and companies need to do payroll, pay utilities, etc., so they were burning through cash unless they had already implemented austerity measures, which, considering the culture of Silicon Valley, I am sure is not the case. Additionally, with rising rates to remain competitive, Silicon Valley Bank also needed to offer higher rates on deposits to remain competitive. All of this resulted in a decline in deposits to the tune of $200 billion at the end of March 2022 to $173 billion at the end of 2022, and the pace of declines was increasing in 2023. Which takes us to a couple of days ago. With deposits dropping and investment losses mounting, the bank decided to sell securities worth $21 billion at the time of sale at a loss of about $1.8 billion after taxes. This would allow the bank to invest in higher yield investments and also provide it with flexibility to meet customer withdrawal needs. Additionally, the company was also going to sell stock worth $2.25 billion. However, when word got out of the sale, it made the market very jittery. The market was already jittery due to the collapse of Silvergate Bank just a week earlier. Now, the circumstances behind or leading to Silvergate's demise was, of course, very, very different than that of Silicon Valley Bank. Silvergate was primarily associated with the demise of the crypto market, but essentially the point being that the market was already jittery. Anyway, back to Silicon Valley Bank. Investors started selling Silicon Valley Bank stock when they learned about the bank's plans. They associated the sale of securities to be liquidity related. This created the stock some 60%, and the bank had to change plans of selling the $2.25 billion in stock. With the stock collapsing and the prevalence of social media, VCs got skittish and told their portfolio companies to pull their funds out of the Silicon Valley Bank, essentially creating a run on the bank. This resulted in another $40 billion in withdrawals, and when the bank was unable to meet the demand for withdrawals, it created the stock an incremental 60%. At this stage, the FDIC had had enough, and with the California regulators, took control of the bank. As I said earlier, it was a combination of factors that led to the run of the bank. The bank's executive team, risk managers, and the board were definitely to blame due to their lack of fundamental understanding of how to run the bank and also focusing heavily on the tech, VC, and private equity world. VCs are also partially to blame for panicking and perhaps not fully understanding the liquidity picture of the bank because the assets of the bank were greater than the liabilities and the bank was technically solvent. And then there are regulators who should also have had a greater read on how the bank was positioning itself both from a clientele and a risk management standpoint. The regulators are also aware at this point in time that there are about $620 billion worth of unrealized losses in securities portfolio as of the fourth quarter of 2022 amongst all banks. And this is a massive, massive number that is out there. All of which is caused by, of course, this rising interest rate environment that we are in. So the question really becomes, where do we go from here? Well, through the FDIC, customers are insured up to $250,000 on their deposits. While this sounds pretty good, it's actually peanuts. This is, in total, would be about 2.7% of total deposits. Remember, the people who had deposits in the banks were VCs, PE firms, tech millionaires, and companies of all sizes, with a sprinkling of individual investors. Silicon Valley Bank estimated that at the end of 2022, the amount of deposits in the U.S. office that exceeded the FDIC insurance limit was $151.5 billion out of this $175 billion in deposits. At any rate, the insured deposits up to $250,000 will be available on Monday per the FDIC, i.e. tomorrow. Uninsured depositors will receive a receivership certificate for the remaining amount of their uninsured funds, and once the assets of the bank are sold, depositors would receive dividends for the uninsured amount. However, this could take several weeks, if not months, to occur. When it comes to bank failures, it's difficult to contemplate the true impact of a bank run. The impact will be felt by employees. The impact will also be felt by employees whose employers fund their payroll through Silicon Valley Bank. With no paychecks, employees will not be able to meet their day-to-day needs. They will not be able to pay off their mortgages. This would, of course, have an impact to Silicon Valley real estate market. The impact will be felt for mortgages held by the bank and investments done by the bank as it had its own venture arm. And then there's the broader question. What other banks are out there that have mismanaged their investments in this rising interest rate environment? Where else is there a mismatch between investment and customer deposits? Where else are customer deposits declining? Some banks that are already experiencing a significant amount of pain include First Republic, PacWest Bancorp, and Signature Bank. The regional bank ETF is also getting absolutely slaughtered. And in the event another bank encounters a similar issue, or if there is no guarantee by the government for Silicon Valley Bank customers on their deposits in excess of the $250,000 and made available in short order, regional banks could be in deep, deep doo-doo. I'm sure lots of customers are already moving their funds out of the regional banks to the bulge bracket banks, and for good reason, myself included. The bulge bracket banks and JP Morgan, Bank of America, Citigroup could be the biggest winners after this whole debacle. It'll certainly be interesting to see what happens in the next few days and weeks. But if there isn't a resolution or some path forward prior to the market's opening, all bets are off. In the end, I'm sure the bankers and big money VCs will be fine. The scales are tipped in their favor anyway, irrespective of how much foul they cry. Also, Silicon Valley Bank had sufficient assets to offset their liabilities, so eventually, most will be made whole. It's just a matter of time. I also think the notion of this being an extinction-level event for innovation, startups, and VCs, and the U.S. falling decades behind China in innovation is a bit of an exaggeration served by self-serving VC bros. But at its core, the non-millionaire class of banking customers will feel the pain, and the markets will experience significant volatility if there isn't a resolution in short order. And if you like the contents of this video, like, subscribe, and leave a comment, and I'll see you in the next one.